Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
3 retirement success questions you must be able to answer. First of all, you have to know how much income you need or want in retirement. Now folks, a lot of people will start with what they're making as they're working, right? Wouldn't it be nice if you could enter into retirement making as much as you were when you were working? That would be ideal, right? And that would be a great place to start. But what if we have to kind of put the pencil to the paper, as they say, and kind of nail that number down a little bit? That would be highly recommended, because if we're going to do an income plan, we have to know what income we're planning for. So the first question we have to ask is, how much income do we want or need? Let's start with that number. The second question we want to ask is, how much income can I count on that's guaranteed? All right, there's only a few sources of what we would call guaranteed income. There's Social Security, it's backed by the U.S. government, so hopefully that's going to be good. You've got pensions, okay? They're going to be guaranteed by either a government or some company. Now, hopefully it's a company that's got good credit quality that's going to be around for a while, because maybe it won't be guaranteed, right? But these are sources of income that we can hopefully count on. Another one might be an annuity, like a TIAA-CREF or something that's spitting out a guaranteed income. But this is, if we answered the first question, how much income do we want or need, and then we can answer the second question, how much income can I count on to be guaranteed to be consistently coming in, the last question we have to answer is, where am I going to make up the difference? Let's say I want or need this number, I know I can count on this, but what's that? Where's that going to come from? Folks, that's going to have to come from your retirement savings. These are all those accounts that you've been hopefully putting money into to save for retirement. Those IRAs, the 401ks, the 403bs, the 457s. And by the way, all those numbers, all they are is IRS tax codes, okay, showing those sections. So if I know what I want or need, I know what I can count on, and I'm going to try to make up that difference, how do I know how much that difference needs to be? All right. As a general rule, when we're pulling from retirement accounts, we like to use what we call the 4 or 5% rule, meaning that's how much of our savings we can pull and count on for income. Now, it's not brain surgery, because if we can get an account to grow by 4, 5, 6% while we're pulling out 4 or 5%, then that's going to work all day long. But most important, as you can tell, I'm going to have to be sure that that's a consistent income that I can take. So folks, those 3 questions have to be answered. And then once we answer them, putting that together in a plan that also accounts for inflation is going to be very important. So if you're somebody that wants that kind of planning, want an income plan, want to know if you have enough for retirement, then please give us a call.
Every success story starts with a plan. The success of your retirement depends on a solid financial plan. If you are nearing retirement or already retired, we invite you to an informative live event to help you plan to retire well. There is no cost and no obligation, and dinner is on us. We are Centennial Wealth Advisory, financial professionals, specializing in retirement planning and serving all of Northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. Our presentation includes highlights of the Tax Cuts and Job Act of 2017 and the big opportunity it presents over the next 7 years. The surviving spouse tax trap, how can you avoid it? How 2 similar portfolios can end up with 2 drastically different results. What's the definition of a bull market? Do you know your risk exposure? And much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, March 10th at Boone's Long Lake Inn in Traverse City. Thursday, March 12th at Lakeside Charlie's in Cadillac, or Tuesday, March 17th at Big Buck Brewery in Gaylord. The live event starts at 6 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and tends to fill quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event to help you plan to retire well. Call 888-608-5825 today.
Welcome. In this segment, I want to talk to you about one reason that you might want to wait in taking Social Security. Now, there's a lot of factors that go into determining whether you should take it early or not, but I just want to give you one today that I want to focus on, and that's income taxes. Now, what I have here is I have a married couple. They're both age 62. They've decided to take Social Security early, okay? They're going to take a combined amount of almost $33,000 out. Now, they want $72,000 of income. So they're just going to take an additional $39,000 out of the IRA to make up the difference. Now, Uncle Sam says in this scenario, now it's kind of a complicated formula they go by to determining this, but basically they take half your Social Security, all your other income, and when you hit a couple different thresholds, it'll determine how much of your Social Security becomes taxable income. Now, I'm not going to go into great detail of that right now, but just understand that this couple taking almost $33,000 in Social Security, just about half of it is going to be taxable income. So then they get a standard deduction of $24,000. Their income tax in this particular case, or their taxable income, is $30,000, almost $31,000. Income tax, $3,330. Now, if they'd waited to age 70, okay, their Social Security benefits have grown, almost double what they would have been at age 62. In this particular case, if they waited to age 70, their combined Social Security would be almost $58,000. Now, they still want the same income of $72,000 at that time. So now, though, they only have to take $14,000 out of the IRA to make up the difference. Remember, back here they had $39,000. Now it's only $14,000. In this particular case, now Uncle Sam says out of that all that Social Security, only $5,528 of it is taxable income. Now, in this particular case, I got a little higher standard deduction because now they're older than age 65. But in this scenario, taxable income is zero. Income tax is zero. Now, how much tax do you want to be paying on your IRA money? I would dare say if I can get to a place where I can take money out of my IRA and not have to pay any tax at all, then that was a great scenario. Because remember, when I was putting money into those accounts, I was getting a tax deduction. Now, if I take out of those accounts and I'm not paying any tax, what could be better than that? Folks, again, there's a lot of different reasons why you might want to wait to take Social Security. This, again, was just one from an income tax standpoint, but very vitally important to understand.
Wonderful topics, Larry. You know, you're thinking about this here, and makes me think about income planning. You know, we talk so much about planning on this, and it makes me think of a puzzle. You know, all these different pieces of income planning. You know, over the weekend here, worked on a puzzle with my daughter, and you know, it can be interesting as we're putting together this puzzle and kind of working together on that. And there's always seems to be that piece that's missing. You know, and if that's your retirement plan, you know, that puzzle is kind of worthless without all the pieces. And if they're not all in the right spot, just as a retirement plan, it could really lead to the demise of the plan. You know, Larry talked a lot about, you know, reasons to potentially delay Social Security from a tax perspective. So often, you know, people they come in and talk about, well, I want to take it now because my family didn't live that long. They go to longevity, or I'm going to get it now because it's not going to be there. They have these other things, but rarely does that ever come up from a tax thing. That's just another piece in that puzzle to put in there that's vital to get in the right spot.
Yeah, and it's interesting too, sometimes guys I come across where we're talking through an income plan and people are really hesitant to ever start actually drawing income from the portfolio because they're afraid, oh, I'm going to run out of money and everything, and it's a legitimate concern, obviously, but it's also one where it's the fun part of our job sometimes to say probably the biggest challenge we might have is getting you to spend your money during your retirement years, and it's so important to know, exactly how much money you can spend, so that way then you can plan those trips. So, we enjoy seeing our clients accomplish those bucket list items early on in their retirement years, because you never know what can change. Health changes and what have you, and all of a sudden you're not able to go on those trips. So we want you to enjoy your retirement years.
Yeah, guys, it's amazing how few people we see coming in anymore that have pensions. It seemed like it was very prevalent 9-10 years ago, but now we see very, very few. And when people don't have pension income and all they're relying on is Social Security and their savings, they really want to know how that's going to work out. So yeah, again, getting back to that income planning, we can do that plan. We can figure out how much you're going to need for income. We can look at Social Security, maybe when to take that. How much growth do we have to have on the investments? Because the idea is we don't want you to run out of money. So having a plan is very, very important. Now, folks, I want you to stay tuned, because in the next segment, I'm going to be talking about 529 college savings plans and talk about when I might need a ladybird deed. So stay tuned.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
If you're retired or approaching retirement in the next 5 to 10 years, join us for an informative live event. This event is all about you, the challenges you face, and the information you need to help you build the future that you want. There's no pressure to become a client. Our goal is simply to give you valuable information that you can use to make smarter financial decisions. We hope that by the time you leave this event, you'll be one step closer to your retirement goals. Hi, in this segment I want to talk about 529 plans. Now these are accounts that parents and grandparents can put money into, okay, with after-tax dollars. Now for the state of Michigan, I think they allow you a deduction for MESP, but it's money you can put into an account that's called a 529 plan. It grows tax deferred, and then if it's used for education, then none of it is taxable. Now, just about every state has some version of this 529 plan. I know some of the universities will have their own 529 plans too. Now, 529, how it gets that name, it's just the IRS tax code that created these kind of plans. Now, mutual funds, just about every mutual fund company out there will have these 529s that you could do with them also. So there's a myriad of them out there that you can participate in. And again, they're like a Roth IRA in the sense that you're putting in with after-tax dollars, they grow tax deferred, and then if they're used for the proper purpose, then it's going to be tax-free. Now, what are educational costs that it can be used for? Well, for any university, room and board, okay, the actual tuition, their books, basically any educational costs they have for that education. Now, 529 plans allow for any tuition from K to 12. Okay, so you can use it for that as well. Now, the state of Michigan has two plans. They have one called the Michigan Education Savings Plan, MESP. Now, that one looks like mostly others. You're putting money in, and it'll have some accounts that you can choose from, conservative, moderate risk, and basically you put into them, and then those funds basically manage that money going forward. And what you're hoping is that they grow to enough to be able to cover those costs when the time comes that you need them. All right. Now, they're subject to market risk, which is in college education, university costs have been rising at very dramatic rates of recent years. So, the growth on these, unless they're totally aggressive in the market, is having a hard time keeping up with those college costs as they're increasing. The one I really like is called Michigan Education Trust. Now, this one is more of a prepaid tuition plan. You literally pay for the costs ahead of time. But the nice thing about them is it doesn't matter how the college costs rise, you're basically guaranteeing that education is going to be paid for. So I can pay for it today, 2 years at the university or 2 years at community college at today's rates for what that's going to cost me down the road. So I really like those. Now, for these 529 plans, you got to be careful. If the kids have them in their name, they can be, for FAFSA reasons, financial aid, 20% of it can be considered their assets. But if you leave it in the parent's name, only 5.64% is considered assets for FAFSA. Now, grandparents can put into these 529 plans, and that's not a bad idea. Not usually good in the first couple years, but in the last couple years of their education can be very advantageous. So if you're somebody that's trying to save for college and maybe want some help trying to figure out which plan might be good for you, give us a call. We'd be glad to help.
Well, Larry, that was kind of a refreshing change of pace, with the topic here. We talk so much about retirement planning, and diving in a little bit about 529s and the various likes of those plans is interesting. And so for those of you out there, that maybe have done your retirement planning, have planned for yourself to retire well, now maybe you're looking on the grandkids and stuff like that. Larry, kind of what my big takeaway was is you were offering to open 529 plans for my kids and John's kids. I mean, I have 5, John has 3, that's only 8, and what's the max every year?
That too,
right,
it's on tape now.
Exactly. So so that's really nice of you to yearly do that for us. Yeah. So
and if I agreed to that on TV, it's forever a contract, I'm assuming too. How about this? When I get my 4 grandkids taken care of, if there's anything left, I'll help you with yours. How about that?
Okay, I guess we'll take that as a settlement. So, but no, I think it's a great thing to consider. A lot of times we get those questions from grandparents that say, we've done a great job saving for ourselves, and we're fortunate here. What else can we do for the kids or grandkids? What else can we look at through gifting and all these different methods? So it's interesting to kind of take a look at that. I know, John, you have children, and maybe your parents, grandma and grandpa, are watching as well there,
right.
And they're taking a few tips.
Yeah, exactly. And one of the things, Larry, that I caught in that and talk through maybe a little bit of, there are some tax benefits built in for that particular state. Is that right?
Yeah, every state has their incentives to try to get people to put into these plans. The state of Michigan does give us a deduction if you put into an MESP plan.
Okay, and then I know compare and contrast a little bit the MESP versus the MET, how those work and maybe what advantages or disadvantages.
Yeah, the Michigan Education Savings Plan works like mostly all other 529 plans, where you put it into some kind of account, you pick between conservative, moderate, and aggressive, and they grow, but they're subject to market risk. So here you could be putting in for the college savings, and we get hit like with a 2008, and market drops to half its value. You don't have all the money you wanted there for education. I really like the MET, or Michigan Education Trust Plan, because you're prepaying the tuition at today's rates, basically. When my kids were really young, I remember what the lump sum amount was I could have put in there to pay for my kids' college education for 4 years. I could kick myself for not doing it.
Sure.
Now, I didn't have a lot of money at that time, so it was harder, but I could have made payments into it. So I highly advise it. And by doing the MET, you're guaranteeing the kids' future college costs are already paid for at whatever rate they're at. So if they continue to grow at double-digit rates, then you're kind of guaranteeing double-digit growth on your account that you just put in because you already prepaid it.
Sure, so. Very good information. Then one other thing that came to mind too was as far as how to title the accounts, whether it's in the grandparent's name or the parent's name, and how that all works.
Yeah, this is why I really wanted to talk about this, because we get so many clients, they've done a really good job planning for their retirement very well, and now they want to give some away. They most particularly looking at their grandkids and saying, hey, what can I do to provide for them? But actually, if it's in the grandparent's name for the child's benefit, in that first 2 years of college, that can actually hurt them because it counts as the child's income. And then that works harder on them for financial aid. The best time to have the grandparents on it is in the last 2 years, because FAFSA, financial aid's always looking at the prior 2 years. Well, after the second year, now they can't use it. Okay. But most generally, it's better to have it in the parent's name for the child's benefit.
Really good information. Yeah.
Now I want you to stay tuned, because in the next segment, I'm going to be talking about ladybird deeds, when you might want one. And then I'm going to talk about the financial cycle. It's a business financial cycle, but it applies to the economics today. So stay tuned.
NMC Extended Education is introducing an educational class titled Retirement Secrets, Your Best Is Yet to Come. Our very own Larry Flynn will be the presenter. If you are nearing retirement or already retired, then this class is for you. Many things can threaten your ability to outlive your assets and retire well. The 3 big things being healthcare, inflation, and taxes. Learn to navigate the critical issues that a retiree must deal with. You'll learn how to plan for a predictable and sustainable income, minimize taxes on your IRAs, maximize your Social Security benefits, and avoid estate planning mistakes. We'll also discuss long-term care concerns and what investments are appropriate in different situations. The cost is only $69. Materials will be provided, and a spouse or guest may attend for free. The class will be held on 2 Wednesday evenings at 6 p.m. for 3 hours, April 1st and 8th at the NMC Great Lakes campus. Reserve your seats today by calling NMC at 231-995-1700. The class is called Retirement Secrets. Again, that number is 231-995-1700.
Lady Bird deeds, what are they? Now, I think the term comes from Lady Bird Johnson, is it, from what I understand. But what are they? Most of your investments, most of your like your savings account, checking accounts, maybe your investment accounts, you have the ability to set beneficiary designations on those. When you die, they know where to go because you've listed a primary beneficiary. And then in case that primary beneficiary isn't around, you've listed contingent beneficiaries. So this goes in any good estate plan, because what you want in a good estate plan is having all your assets knowing where to go. Now there's one asset you have, though, for the most part doesn't know where to go unless you put it in what's called a Lady Bird deed. That's your home. All right? If you were to leave this earth today, would your home know where to go? Most likely not. So it's going to have to go through probate, and then your will is going to have to determine who that home goes to. But here's what you get to do. If you put your house in what's called a Lady Bird deed, now it doesn't change your incident of ownership, it doesn't change your use of the property in any way. It just simply puts a beneficiary designation on the deed that says, when you die, here's where it goes. Now, and it completely avoids probate. Now, it's a good planning tool when you're looking to, let's say, maybe avoid Medicaid or the state or federal government taking it. Think about it. If you have a house, they tell you they can't take your house to pay for your care if it's the government paying for your care, okay? But if they let you keep your house, but when you pass away, now they can come back after it, all right? Now the way most people used to try to protect it is they try to put it into a trust. But now they say for Medicaid planning, you can't even apply for Medicaid until that house is taken out of a trust. Why did they do that? They did that because they want to be able to attach it, so they don't want you to have it in a trust. But here's the beauty. If you put it in a Lady Bird deed, what happens is it never goes through probate. Remember that. So when you pass away, it goes to the beneficiary, avoids probate, state or federal government can't touch it. So it's a great, what we call elder law planning tool that you're going to see a lot of attorneys want to use. Now, you can also make the beneficiary of the Lady Bird deed the trust. So if you indeed, for one reason or another, wanted it to go to the trust, well then just list the trust as the beneficiary in that Lady Bird deed. Then when you pass away, avoids probate, goes into the trust, then gets distributed according to the trust and how you had it. So folks, this is a great estate planning tool. Listen, if you have a lot of assets and they all know where to go, for the exception of your house, and you want to avoid probate there too, then I suggest you learn more about a Lady Bird deed. Give us a call. We'd be glad to direct you in the right direction.
If you're retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no-obligation retirement review.
Are you retired or approaching retirement in the next 5 to 10 years? Join the Centennial Wealth Advisory team for an exciting presentation with complimentary gourmet dinner and learn essential financial strategies for a comfortable retirement. 3 dates and locations to choose from. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Call 888-608-5825.
Many of you might not know this, but I had my own tax and accounting practice for over 25 years. I had to advise a lot of businesses over those years, and I would always refer to what I called the financial cycle. But I wanted to kind of give you an idea what that looks like today, because I think it's just as relevant when you're looking at the market as a whole. So I just want to show you kind of this relationship and when it's healthy and when it's not healthy. Okay, again, they call this the financial cycle. You know, you got what's called a profit and loss statement. That is basically your sales, the total revenue you're bringing in, minus your cost of goods sold. If you're a retailer, that's the cost of your inventory that you're selling, minus your operating expenses. You know, that's your rent, utilities, wages, all those kind of things. Well, after you take your sales minus your cost of goods sold and your expenses, you get what's called your profit. And you're hopefully hoping that's going to be more than that, right? Now, there's also a financial statement called the balance sheet, okay? That just basically shows you a snapshot of your organization as of a specific point. So it's basically your assets, everything you own, equipment, inventory, buildings, and the like. It has to equal all your debt, your liabilities, and your owner's equity, okay? That's the relationship. Your assets equals your liability plus owner's equity. Now, here's how the cycle works. Your assets help you generate your sales. So if your assets are inventory, whether it be equipment or what the like, they're going to generate your sales. Then it's going to go down through what's called this, what I call the noodle maker, right, to generate a profit. Now your profits can only go one of three places. They can go back up into new assets, okay? They can either go pay debt, okay, your liabilities, or they can go in owner's equities pockets to maybe then turn around and pay dividends, okay? So if this is a healthy thing, you're generating enough profits to be able to do all these three things and generate enough assets in your sales, you have a healthy cycle, okay? But any one of these things become unhealthy, you have an unhealthy cycle. So let's say that I have enough to pay my debt, and maybe I'm paying into the owners, but I don't have enough to fuel my assets, then that's going to slow down my sales, which is going to affect my bottom line. So folks, when we look at the economy and we hear things like low interest rates, okay, that's good for corporations because their ability to pay debt is good. But as soon as interest rates rise, their ability to pay all that to debt gets less and their financial cycle can be hurt. All right? And let's say growth is slowing and sales are starting to decline. That's going to lower their profits and then make this unhealthy. So just like a human being where we have organs and they all have to be in balance, the financial cycle has to be in balance. So when you're hearing things in the economy about slower growth or higher interest rates or any of those kind of things, know that there's a lot of good reason behind it. So hopefully you found this valuable, just something I thought you might want to know about. If we can be of help in any way, then please give us a call.
Yeah, Ladybird deeds are definitely a piece of your overall plan, but again, that's where holistic planning comes into place, and it's important to be looking at all those different areas and making sure that your financial advisor is communicating with your attorney, and if you have an accountant involved, that you're all working together. And that's something really important when you want to plan to retire well. So if on today's show there are certain things that caught your attention, you're welcome to give us a call at the number on the screen, and we'd love the opportunity to sit down with you for a no cost, no obligation visit. Thanks again for tuning in to Retiring Well.